Thanks. Well, welcome again to our weekly 20-minute webinar. I'm Jim McCormick, Global Head of Desk Strategy at NatWest Markets. Joining me once again is our co-heads of Global Economics, Michelle Girard and Ross Walker. And as far as today's agenda, Ross is going to talk about even more downside risks to UK growth. Also this week's record-breaking gilt issuance numbers and the likelihood of more quantitative easing. Michelle's going to talk about the data stories in the US, but also the reopening dynamics that we're seeing around the virus. I will end, as always, with a review of a couple of market themes. And after that, we will have a Q&A. So please text us any of your questions during the call or use the raised hand functions when we start the Q&A. And with that, I'll put it over to Ross.
Thanks, Jim. Interesting data this week in the UK and across the globe, particularly the PMI surveys, the flash estimates for April, generally weaker than expected. I mean, expectations were pretty grim anyway, but in many cases we still saw an undershoot. And if you think of the way the PMI is structured, an improved set of conditions versus the previous month has a coefficient of 1, unchanged a coefficient of 0.5, and worse 0. So you do the maths, but to get prints of around 13 in the UK and the Eurozone is extraordinary. Basically, every single business responding is saying things have either got worse, and a handful have said, well, they maybe didn't get terribly worse, but they certainly weren't getting better. So these sort of levels of the survey, really very sobering, prompting us maybe to rethink our forecasts, maybe for the UK and the global economy. We might be just a little bit too optimistic in looking only for a 13% fall in GDP in the second quarter. But maybe the bigger worry is not so much how much we fall in Q2, but the scale of the rebound in Q3, and not only the data, but some of the discussion going on in policy circles around the easing and how long restrictive sets of conditions will remain in place. And I think there is a growing risk, certainly in the UK, I would suggest, that more severe lockdown restrictions persist for longer. So we could end up with not only a very sharp fall in output in Q2, which pretty much everybody expects, and it probably doesn't really matter whether GDP is down 15, 20, 25% quarter on quarter. But the scale of the rebound in Q3, I think increasingly risks underwhelming, and related to that, that we end up with more persistent damage to the supply side of the economy. We also, this week in the UK, alongside the data, the Debt Management Office gave its updated funding remit. And again, we're getting used to being surprised by telephone number type outcomes, but much bigger borrowing by the UK government in the near term. 180 billion of extra issuance over the next 3 months, significantly higher than the sort of 120, 130 billion that had been expected. But again, indicative of two things. One, there is clearly a fear in policy circles that fiscal deficits are going to spiral out of control. The reason I think not to be worried about that and to continue to believe that yields are going to remain low is that this is just going to solicit more quantitative easing. And the other interesting feature this week, several Bank of England policymaker interventions, but basically reiterating that QE is not, this is not a Zimbabwe-style monetary financing. In other words, paving the way, we think, for an additional QE announcement. Whether that comes as soon as the next BOE quarterly monetary policy report on the 7th of May, that may just be a little bit early, but I think certainly over the summer, we're going to get an additional QE announcement, probably another £200 billion, taking the UK total QE purchase stock up to about £850 billion, or thereabout 40% of GDP. On that note, I shall pass over to Michelle Girard in the US.
Thanks, Ross. A bunch of things perhaps to touch on in terms of of developments in the U.S. this week. The data calendar was relatively light. I think probably a few takeaways I would point out from the data that we saw that struck me as perhaps most significant. As Ross talked about, the PMI numbers obviously showing weakness. In fact, the manufacturing numbers were not as weak as we had anticipated we might see out of the U.S., but of course, the service sector is bearing the brunt of it. And actually the service sector PMI data were even, I think, worse than what I had anticipated that we would see for the U.S. So kind of continuing to underscore that, the brunt of this is in the service sector. And as Ross says, the risk as we move forward will be that the near-term numbers related to services might look even worse. Perhaps on a more positive note, if you could say there's something positive with only 4.4 million people filing for unemployment claims, that number was the second week that the total number of new filings was less than the peak that we had seen a couple of weeks ago. So it sort of fed into the confidence that we're seeing the peak in the number of initial unemployment claims being filed, which is to some extent obviously good news. We also had durable goods orders this morning that for March plunged for over 14%. But if you look past just the drag in transportation, we're surprisingly steady, very close to steady. Looking at, for example, non-defense capital goods orders, ex-aircraft, the numbers were little changed. That's a key proxy for business investment. Clearly, this is just March numbers, but we've actually seen the March data look much worse with more of a COVID impact sooner, and that was not the case with these investment spending type numbers. So. The truth is that the market is continuing to sort of look past a lot of this near-term data. They're looking ahead to the reopening. So in the U.S., the developments this week have really centered around, we've got states now that are beginning to reopen their economies. Of course, the decision to reopen in the U.S. is not held at the federal level. It's held at, it's determined at the state level. And while models that are run, based on kind of infection rates and containment and testing all suggest that no state should be opening before May 1st. We've actually seen some begin. Georgia's, garnered the most attention. They've been the most aggressive. They opened this week. Businesses, non-essential businesses, beginning to reopen. We've seen South Carolina, Tennessee. There's been a number of states that are beginning the process of reopening. This is, of course, happening before, as I mentioned, the models would suggest is prudent. One of the, numbers or prerequisites, if you will, that people point to is, of course, the need for testing. To date, in the U.S., we've tested less than 200,000 people, or less than 1.5% of the population, and the recommended level of testing to safely reopen the economy is thought to be, or recommended to be, 1.5% of the population every day. Just to give you a sense of how far off the mark in terms of the testing that the U.S. currently is. And so that's created a great deal of angst, and there's been a lot of debate about the prudence of reopening versus continuing the lockdowns. And this is a debate that will continue to rage. It has the feeling of pitting economists against health experts, but I guess the truth is as we move forward, it's all going to be about finding the right balance. I don't think anyone expects that as we reopen economies that we won't see infection rates start to rise. I don't think anyone has any illusions there won't ultimately be a second wave. It's all about managing the infections, of course, in a way that doesn't end up overwhelming the health system. So we've got states now that are starting to take actions within, prudent behaviors like social distancing and so forth. And it will be very interesting to see the results there. And that will likely go a long way to shaping sort of the broader response. I'll just end by, kind of noting, we also did see this week more fiscal stimulus with Congress passing another $484 billion of aid and relief, particularly aimed toward funding more for the payroll protection program. So we've got $2.6 trillion now in fiscal stimulus, so about 12% of GDP that's been passed. The one thing I would say is that this additional step was more hard won. It wasn't as easily approved as the $2 trillion in fiscal stimulus. It was actually less than what people had hoped that phase 4 would be, closer to $1 trillion. And so I think one of the things we're seeing is in the U.S. there is a little bit of the tiredness around, or certainly the need to just continuing with fiscal stimulus, unmitigated. So with that, let me stop and I'll turn it back to Jim.
Okay, well, thanks, Michelle. As always, I'm going to kick off with a discussion of markets, and it was a fairly interesting week with quite a lot to ponder. And as always, I'll start with the broad outlook for equities and credit markets. And the S&P 500 is heading for its first down week in a month, although it's a pretty modest decline, and clearly the week isn't over. And really, as has been the case for a while, asset markets are stuck in this tug of war, with bad news on growth on one side and a very strong policy response and better news on the virus trends on the other. And in terms of this week, I'd say it was kind of really more of the same. So we've already discussed the pretty horrific PMI numbers. As for the virus data, I think the story remains positive, but it does increasingly feel very much priced in. So we already have confirmation that the daily death rates have peaked in Europe and the US. We've talked about that many times on this call, but the curve flattening has been pretty slow. We know that the lockdown strategies are being eased, but we don't know in most cases when. We don't know what it'll look like, and we don't know how people are going to respond. So it's a bit harder to get the positive narrative out on the virus now. What I would say is that the one positive note there is the mortality rates in Asia, including the second wave in Asia, remain very low. So China, if you believe the data, has now gone 8 days without a single mortality from the virus, which is the longest so far. In terms of the outlook for credit markets and equity markets, I'll just reiterate what I've been saying for the past 2 weeks, which you still see downside risks over the coming weeks, but there really isn't a strong case for us to test the cycle lows that we saw back in the middle of March. And with that, there's 4 themes that I want to discuss this week. And the first is obviously the oil price. It's hard not to discuss the oil price when the front contract went negative for a time this week, something I'd certainly never seen happen in my 25 years looking at markets. And let me just say that for the broad economy, I'd emphasize very strongly that oil is very much an exaggerated gauge of the current state of affairs. Oil was always going to be the asset price most badly hit, and it's most likely to be the last one to recover. And I think it's quite interesting, if you look away from oil at industrial metals, iron ore especially, you've actually seen a decent amount of recovery, which is one reason why we actually like being long metals-based currencies like the Australian dollar and the Chilean peso. I'd also emphasize that oil below zero does show the stress levels in that market, and that stress matters immensely for oil producers. Long story short, the oil shock is going to create massive stress for what we see as the non-economic producers in this market. And that list includes Canada, Colombia, Brazil, and I'd even throw the US shale producers on that list. And what I'd finally say on oil is I wouldn't read too much into the longer term implications for inflation. Near-term contract is obviously very low, but it's worth noting that Brent 5 years out is trading at $50 a barrel. So clearly the long-term impacts are a little less clear. Second theme is a quick one. I just want to return to something that I talked about last week, which is the very interesting policy response we're seeing in emerging markets. Despite very weak currencies, continued weak currencies, most emerging central banks are cutting rates and cutting rates pretty aggressively. And just over the past week, we saw it happen in Turkey. We saw it happen in Mexico. We saw it happen this morning in Russia. And certainly in the case of Turkey and Mexico, those rate cuts were much more aggressive than what most people had been thinking. As I said last week, there's good news in the story in that we're seeing less inflation pass through which means less reason for central banks to hike rates aggressively, which probably is more supportive for growth in these economies going forward. The bad news is there's really not a case to be made for any real recovery in the currencies. Third theme I want to talk about is government bond supply. We've talked about it a lot in this call, and I just want to say that it does matter for fixed income, even if you may not be noticing it quite so obviously. And two examples in the past week are really important to highlight. So firstly, it was another bad week for European periphery bonds, Spain and Italy in particular. But the nature of that weakness was very different this time around. It wasn't really about worries about Eurozone breakup, Eurozone stress. So volatility wasn't especially high. Equities weren't hit particularly hard. It was really about supply. We saw the largest syndications in Italy and Spain in their history, and clearly it had an instant impact on the price. Another place I'd look is European money markets. So, we have seen a lot of stress in money market yields in Europe. And again, this is not anything to do with stress around the Eurozone. If you look at the supply plans for Europe, they are using the bills market much more than anywhere else in the world. And it's clearly creating some digestion within the market. So net, I'm just going to repeat something I've been saying throughout these calls in recent weeks, which is the value proposition for core fixed income in a world of massive fiscal deficits is not particularly obvious. So finally, I want to talk about a really interesting theme, yield curve control, a topic that's getting quite a lot of attention recently. And the timing is quite appropriate. We had this article in the Nikkei News overnight suggesting that the Bank of Japan would abandon its 80 trillion yen annual purchase target and commit to unlimited JGB buying. So a lot of people got excited about that. It's a very dramatic headline. I would argue it really doesn't mean anything. The fact is the BOJ already runs a yield curve control framework, which means under certain circumstances, they've already committed to buying unlimited JGBs. It would certainly be an interesting story if the BOJ was also planning on lowering its yield targets, but they're not planning to do that. I think what the story really tells you is after 4 years of running a yield curve control framework in a very benign environment, things are about to get much harder. Raises an interesting question of, are we going to see yield curve control outside of Japan? Don't know the answer to that. We may pose it to Michelle in the Q&A when it comes to the Fed. Also an interesting question of whether or not yield curve control will work. Also a tough question to answer, but we do have the Bank of Japan experience. We also have the Fed's experience back in the 1940s. And I'd say there's 5 lessons to take away when thinking about this yield curve control story. Firstly, as I said already, the BOJ's had it pretty easy over the past 4 years. That's about to change. Second thing you've learned is that it's very hard to control a steep positive curve. It's much easier to focus on yield curve control in a flat curve environment. So longer end of curves will struggle for central banks to control. Third point here is that in the 1940s, the Fed was very successful in controlling the yield curve. It was much less successful in controlling inflation. And many will argue, I'm sure, that the 1940s is not a good example for the environment that exists today. I'm not totally convinced of that. Certainly, we can talk about that in Q&A. Fourth point is that in both episodes, the Fed in the 40s, the BOJ recently, government bonds were mostly held by domestic investors. Today, it's very different for the US, for instance. 40% of the Treasury market is held by foreigners. I certainly think that matters and will complicate issues. And then finally, what we've seen with yield curve control is once central banks get tightly linked with governments, it's very hard to break free. So lots of interesting questions to ponder as we discuss this topic. And with that, I'll pass it back for Q&A. Yeah, so I am going to pose this question to Michelle. So I did the easy part of not answering whether or not yield curve control was coming in the U.S., where there is a big focus. What do you think? What's the probability that the Fed does move toward yield curve control?
Well, I will say, so from a very near-term basis, obviously, for example, we have an FOMC meeting this week where nothing is going to be announced in our view, whether it's other additional facilities or or yield curve control. But I do think it's going to be the conversation about yield curve control that will be of interest. I am sure in the Q&A, Powell will be asked about it. Our expectation, it's something we're watching. It's not something at this time we're expecting that the Federal Reserve to do. There are obviously a lot of issues that moving to that strategy brings up, particularly how do you ultimately extricate yourself. I think delving a bit deeper too, one of the distinctions that we make versus yield curve control, for example, that we saw in Japan is how the Fed might actually go about it if they do end up going down this road. It would be very different. The intent that Japan had in undertaking yield curve control, of course, was to pin long-term rates. And in our view, what the Fed would be doing if they undertook yield curve control, and this is along the lines of what Fed Governor Brainerd had suggested, it would be more about sort of using it as a form of strong forward guidance. It would more likely be about pinning yields in the shorter term part of the curve, in the 2 or 3 year sector, to sort of suggest that you are not, the market shouldn't be anticipating any kind of a quick reversal in Fed policy. Now, again, I think the Fed can accomplish this in other ways. One of the things we've long been expecting is when the Fed actually does release its conclusions of the monetary policy review, it will shift to average inflation targeting, reinforcing the point that rates are not going to be raised. The easings that have done will not be reversed this time until inflation is at or above target. So we're already seeing, we've already gotten forward guidance. We see avenues through changes in policy approach, even just in terms of again, average inflation targeting or something of the like that would kind of accomplish the same thing. Yield curve control used as another form of forward guidance is possible, but it seems like it's more of a risky scenario versus the alternative options.
Just let me ask Ross. Treasury yesterday announced massive gilt issuance. You're talking about more Bank of England quantitative easing. How close are they to discussing yield curve control?
Yeah, yield curve control hasn't really featured much in terms of the BOE's deliberations. And historically with QE, they've tended to spread purchases relatively evenly with the express view of minimizing distortions across the curve. If you think about this from a real economy perspective, however, beyond say 5 to 7 years, maybe certainly beyond 10 years, those lending rates for the real economy, for businesses, households taking mortgages, are really irrelevant. Who cares about the funding cost at the long end? Well, it's governments, and so the BOE, might end up sort of treading a little bit carefully here, because there clearly there's an awareness there that there is a discussion about is this monetization, is there a politicization of monetary policy, and so on. But I think the basic reality is that, as Michelle was saying, they have no interest in seeing longer dated yields rise aggressively. They don't want to sell off. From a forward guidance point of view, they'll clearly want to sort of reinforce any policy action today. You don't want to be making these huge purchases and then rhetorically giving some of that up further down the curve. So I think it probably it creeps into the UK debate, but I'm not sure it's, at least from an MPC policy perspective, it's necessarily going to go anywhere in a great hurry. That's not to say, of course, that market participants will not be talking about this, and people positioning and trading around those sort of yield curve control themes.
And so our head of sterling options trading this morning was mentioning there still is a great deal of interest in sterling options toward the end of December. Is there a risk that we either have a delay or a crash out, no deal Brexit? And are we going to have that conversation again very soon within markets?
Yeah, and the conversation, I think, is now just starting, because we're coming up to the first marker post in this Brexit transition extension, which is in the withdrawal agreement treaty. A one-off extension can be agreed, but needs to be done by the middle of this year. Now, if we don't get an agreement by the end of June to extend the transition period, I think you are going to see some wobbles in in the currency markets. I think the pound will be under pressure. And this is a potential, not just short-term, but medium-term complication for the BOE in terms of its inflation remit. So there are significant risks around that. It may be even, if we got through the middle of the year without an extension, markets will still think that a way will be found to get an extension of the transition period before the end of the year. So the cliff edge isn't really there. But, you're again into this sort of high stakes poker game. I think for various reasons, the UK government feels politically it doesn't want to be seen to be the one initiating that request. So in some ways, you just hope that on the EU side, where there's far less of a face-saving dimension to this negotiation, that somebody on the EU side would just say, it would suit us if we had an extension, because we have lost some time in the early part of the year with the coronavirus process. And by the way, even if you agree an extension, and even if you agreed to have a 2-year extension, there's then no commitment to, run the process through that full 2-year period. As soon as you had a trade deal that was ready to go, you could agree it and move on. So it would be entirely pragmatic, I think, to have an extension, just to agree it by mid-year. Why have this issue lingering, weighing on the currency, causing volatility? It feels 50-50 whether we get the extension agreed by the end of June. On balance, I think it's more likely that there is an extension agreed by the end of the year, even if it's only for 3 or 6 months. Politically, I really don't see, final word on this. I don't see what the great problem is from the UK side. Brexit has happened. The UK has left the EU politically. To have a short technical extension period to make up for some lost time that the coronavirus ate into doesn't, to me, seem to be a huge problem.
I don't think there are any more questions today. So once again, we thank you for calling in, and we look forward to seeing you this time next week.